You see it flashing on the news. You check it before a trip. It's this number that seems to control how much your money is really worth. But what the bleep is an exchange rate? Well, let's break it down.
You know that feeling, right? You're on vacation somewhere amazing, you buy a souvenir, and the final price is either a happy surprise or a bit of a shock? That weird, sometimes wonderful conversion? That's exactly what an exchange rate is all about.
So, at its most basic level, an exchange rate is simply the price of money. Yep, that's it. Just like there's a price for a cup of coffee, there's a price for a euro, a yen, or a pound. It's just what you have to pay in your currency to buy a piece of theirs.
To put it a little more formally, the exchange rate is the price of a foreign currency in terms of your home currency. So, if the dollar to euro rate is, say, 1.20, it just means 1 euro is going to cost you exactly $1.20. Simple as that.
Okay, let's make this a little more fun. Imagine you're an international spy and you need a new tuxedo. The price tag you see in that fancy shop window, that's only half the story. The actual cost to you comes down to the exchange rate at that very moment.
So, check this out. Whether that tux costs 2,000 pounds in London, a cool 300,000 yen in Tokyo, or $3,000 flat in New York, the real cost to a US buyer is exactly the same at these specific rates. The exchange rate is like a universal translator for prices, letting us compare apples to apples no matter the border.
But here's the thing, those rates are never still. They're always moving. And you've probably heard people on the news talk about a strong dollar or a weak euro. So what does that really mean? Well, think of it as a currency flexing its purchasing power on the world stage. Now, here is the one thing that can feel a little backwards, so stick with me. When your currency appreciates, when it gets stronger, the exchange rate number actually goes down. Yeah, down. Why? Because it takes fewer of your dollars, say $1.10 instead of $1.20, to buy that same 1 euro. Depreciation is the opposite. Your money gets weaker and that number goes up.
And this isn't just theory, right? It happens all the time. Let's take a look at a real-world example from our source data, focusing on what happened between the US dollar and the euro from late 2014 to 2015.
Okay, look at this. At the end of 2014, it cost about $1.21 to buy 1 euro. But just a year later, it only cost $1.09. That number went down, which means the dollar got stronger. In fact, it appreciated by over 10% in 1 year. That is a huge shift in the global economy.
So if all these currencies are constantly being traded back and forth, where does it all happen? Well, it happens in a market so incredibly massive, it's almost hard to wrap your head around. Welcome to the foreign exchange market. Just take a second to look at that number, $5.3 trillion. And that's not a year or a month, that's how much currency gets traded every single day. It absolutely dwarfs every stock market on the entire planet combined. Now, what's really interesting is that the Forex market isn't a building you can go visit. Think of it more like a giant decentralized computer network that connects banks all over the world. The big hubs are in places like London, New York, and Tokyo, but it's always running, somewhere. Most trades are spot contracts, which is just a fancy way of saying an immediate exchange. But they also deal in more complex stuff called derivatives. So why would anyone use those complicated derivatives? It really boils down to two totally opposite goals. On one side, you've got hedging. That's all about playing it safe, avoiding risk. A company might use it to lock in an exchange rate for a future deal so they don't lose their shirts. And on the other side, you've got speculation. That is all about taking on risk. It's basically making a bet on which way a currency is going to move, hoping to score a big profit.
Okay, but a market this huge can't just be total chaos. There have to be some rules of the game, right? And there are. Governments generally pick one of two main ways to manage their currency's value.
So on one side, you have a fixed system, or a peg. This is when a government jumps in and actively works to keep its currency's value tied to another one, like how Denmark's krona is pegged to the euro. The other option is a floating rate. This is where the government basically takes its hands off the wheel and lets the open market, supply and demand, figure out the price. The US dollar is a classic example of a floating currency. And that brings us to the secret sauce, the invisible force that makes this whole $5.3 trillion a day market actually work. It's a principle called arbitrage, and it's basically how the market keeps itself honest.
I mean, think about it. With all this cash zipping between computers in different cities across the globe,
Why isn't a US dollar worth just a little bit more in London than it is in New York for a split second? What keeps the price the same everywhere? Well, the answer is arbitrage. It's the constant high-speed hunt for tiny little price differences. If a dollar is worth a fraction of a cent more somewhere, traders, or more likely their super-fast computers, will instantly buy it where it's cheap and sell it where it's expensive. That action, happening millions of times a second, makes that price difference vanish. It's a perfect self-correcting mechanism. This system is so perfect, it even works across 3 different currencies. So, if you convert dollars to euros and then those euros to yen, the amount of yen you end up with has to be the same as if you just went straight from dollars to yen. If there's any difference in that loop, even for a millisecond, an arbitrage opportunity exists. And by grabbing that tiny, risk-free profit, traders slam the loop shut.
All right, let's put it all together. What do we learn? An exchange rate is just a price. A strong currency means it takes less of your money to buy foreign currency. All this trading happens in the mind-bogglingly huge Forex market. And the whole thing is kept in perfect balance by the invisible, self-correcting force of arbitrage.
And understanding all this really matters because, as our source material says, these big economic problems we face happen in economies that are all tied together, and exchange rates are the ties that bind.
So we'll leave you with a question to chew on. The next time you hear someone on the news say the dollar is strong, what are you going to think about? Will it be how much cheaper your next vacation could be, the price of that imported cheese you love, or maybe just the real-world value of the money sitting in your own wallet? Thanks for tuning in.